What's up, guys? This is Dr. Crypto here. Today we'll be discussing how do institutions hedge their trades to kick retails out of the market, and what is the best possible way you can use to hedge your trades and close your trades in profits. Okay, there are two trade setups right here. One is the short and one is the long, and we'll be discussing on candlesticks in details what is the best method you can use to hedge your trades. But first of all, you will be using the paint section, so it would be damn easy for you to understand what is hedge mode and how do you use hedge mode. Okay, hedging your trade basically means opening longs and shorts at a time. Okay, opening short against your long at same time or long against your short at same time is called basically hedging your trade. Now, to understand how do institutions or how do the hedge fund members hedge their trades, you need to understand the retail backgrounds. How do they hedge their trades? Okay, so there are two type of retails who hedge their trades. First of all, those retailers who don't know any shit about trading and they just hedge their trades in FOMO. These are those retailers who don't know any shit about chart patterns or all those technical analysis. The second type of retailers are those retail traders that don't use stop losses in their trades, that we call dump money or the retails. Let's suppose these type of retailers are in a bearish trend. Once they are in a bearish trend, they are waiting for the price to retest this trend line, and now their shorts will be triggered from this trend line. But what happens, institutions obviously like always traps them for a while and price moves against them. As now they haven't used any stop losses in their trades, what happens, they are now in negative positions and now they are in FOMO. Price continues its bullishness for a while and now they are in good losses. Now, being in FOMO, open long against their shorts. They don't want, obviously they don't want to lose money. But what happens, price continues its bullishness, makes new high. These retails now are in negative in their sells but in positive in their buys. What happens next, any smaller time frame structure shift towards bearish will make these retails as more bearish as they were previously, because they were already bearish, and now once the smaller time frame shifted towards bearish, the retails are the mindset of retails are now completely shifted bearish, because they want to DCA their short trade as well to get out of their negative positions. What happens, they close their long trades right here, but the short trades is still open. Okay, now they have DCA'd their short trade at this point because they want to close this trade above their entry points, maybe at the zones right here. But what happens, once they close their longs to DCA their shorts, price moves higher and higher and makes new highs, they get liquidated right here. Basically, they don't knew about hedging their trades that made them lose money. So we'll be discussing now how do institutions use hedge mode to get out of their negative positions. Okay, let's suppose we were in previously in a bullish trend. Once we were in a bullish trend, the demand zone was right somewhere right here. Now we want the price to come to our demand zone to find possible longs in price and target some of these highs. Okay, but if we shift on any smaller time frames in this price action, small time frame would be looking like this. And once we get a structure shift towards bearish on smaller time frame, we will short this price action to target this demand zone, and if price reaches towards our demand zone, we will hedge our trade and we will target the highs. Okay, in that case, let's suppose we get bearish shift on small time frames and now we are in shorts in this chart. Price continues its bearishness and comes towards the demand zone of higher time frame analysis. Now we have not closed this trade completely, but we had booked our partials and break even this trade, because we never know price can continue its bearishness as well price can return towards from this demand zone to clear some of the highs. Okay, we can't guarantee it. Okay, what happens next, price comes to a demand zone of high time frame, holds it for a while but continues its bearishness. What happens, we made a loss in our long trade, but as far as we had hedged the trade with proper risk management like institutions do, that's why after losing this long trade, we were in -1, let's suppose, but our short trade was still open with the break even in this trade, and now after losing this long trade, we are still in profit. Okay, so it may be confusing for you. Make sure to pause the video and make your notes, and now we'll be discussing this on candlesticks, so it would be very easy for you to understand. Okay, We are on 2 hour time frame and clearly having a bullish trend, making higher highs and higher lows. This was the low that break this high, and we are now considering this to be as a protected low. What does I mean by that is, here is our advanced demand zone that we'll be discussing in our coming video step by step. That's not the stuff to be discussed right now. Okay, so once price made this low, price this high was broken and this was our protected low. So now we are shifting on any smaller time frame to give us a clear range to short this setup from here, targeting this demand zone, and price when comes towards this demand zone, we will hedge this our short with our long trade, but our short trade would be still open with break evening that. Okay, so let's suppose we are shifting towards 10-minute time frame and we want a structure shift. It is the protected low of higher time frame, but this is the recent low that we want to be broken with a candle close. Once this closes with a candle close, we will short this setup. Confirmation would be through Wyckoff that we had been already discussing. Okay, so let's play the chart. Price moves up, this low was broken, so smaller time frame, 10-minute time frame had been now shifted towards bearish, and now we want a small retracement from the price to hit the supply zone of 10-minute time frame and to open our shorts till the demand zone of 2 hour time frame. Price moves up, tries to break this high, but it was a wick, and wicks are usually liquidation grabs. Okay, so this is basically the distribution phase of Wyckoff that we had been discussed in details, not to be discussed right now. If you want to learn distribution phase, the links would be above right here. You can just watch that. Price moves up and breaks this low, and now once this low got broken, we are quite happy with our profits from this short trade, and now we are supposed to break even this trade, and now we have closed our 80% of position at this by the break of this low, and we have now break even this trade. What happens next? Price moves down, medicates the demand zone of 2 hour time frame and triggers our long position. But what happens next? The next moment our long trade just hit its stop loss. Okay, now we are in -1 in this long trade, but keep in mind our short was still opened with break even. Okay, we hedged this trade by opening long against the short trade, but unfortunately we lost the long trade, but our short trade is still open with break even. Okay, what happens next? Price continues its bearishness because we cannot ever guarantee that institutional order flow can remain bearish or bullish. That's why we were break even on our short position, and still our 20% position was opened right here. What happened? We tried to hedge our short trade by opening long at this demand zone, but unfortunately we lost this long, but our short trade completely hit its targets, and that closed our trades in quite profits. This is basically the right method to use hedge mode in your tradings. Okay, so that's enough for today. Make sure to watch this video again and again and make your notes. Make sure to subscribe my YouTube channel and join us on Telegram for free trading signals.